Welcome back to Investing Talk Podcast.
Today we're looking at Bitmine Immersion technologies.
As usual, before we start, subscribe, like, and comment to this video to support the show.
And you are definitely going to want to pay very close attention today.
Oh, absolutely.
Because we're looking at this central mystery that, honestly, it just completely defies traditional market logic.
Yeah, in a perfectly efficient market, assets are, they're supposed to be priced logically.
Right, exactly.
Right, if a company has $1 sitting in a bank account, the public market should value that company at a minimum of $1.
It makes sense. That's Finance 101.
Right, but imagine this scenario for a second. You crack open a company's balance sheet, and you see that they are holding a staggering $14.0 billion in highly liquid crypto and cash.
It's hard to even wrap your head around that number.
$14 billion, but then you look at their market cap.
Well, Wall Street says the entire company's actually worth.
Exactly. You look at the market cap, and it sits at only $9.26 billion.
It is a jaw-dropping disconnect. I mean, you were looking at a $4.7 billion gap between what the company physically holds in high-conviction assets and how the market is actually pricing its equity.
Which translates to, what, a 66% discount?
A massive 66% discount, yes. And it's the kind of puzzle that immediately demands an investigation, right? Because gaps like that, they simply do not exist in modern finance without a very compelling reason.
Wait, a $4.7 billion gap. In an efficient public market, a discount that massive usually means Wall Street sees a fatal flaw that the average retail investor just doesn't see.
Precisely, the market is pricing in a catch.
So the overarching goal of this analysis is to figure out if this massive disconnect presents a generational value play.
Or if we are looking at an incredibly well-disguised value trap.
Right. That is the core puzzle we are solving today.
Our mission is to figure out exactly why that gap exists and, more importantly, what it actually means for you as an investor.
And to do that, we are going to rigorously evaluate the underlying financial metrics, analyze the chart momentum, gauge the broader market sentiment, and, ruthlessly assess the potential risks.
It's the only way to get a clear picture.
So as we walk through this today, I really want you to keep that $4.7 billion gap at the front of your mind. Let's shift gears and look under the hood at the fundamentals.
Oh, the fundamentals. This is where it gets weird.
Because if you just run this company through a standard stock screener looking for traditional operational cash flow, the numbers are going to make you want to close your laptop and just walk away entirely.
You're referring to what I like to call the revenue paradox of Bitmine.
Yeah, unpack that for us.
Okay, so if you look at their trailing 12-month revenue, it is a mere $6,000.
Wait, I'm sorry, $6,000.
Not $6 million. $6,000.
That's unbelievable.
It gets better. Furthermore, their net income sits at $349,000, and their earnings per share is literally one single penny.
That is incredible. I mean, that is like owning a $14 billion digital fortress, but your only actual income is the $5 you made selling lemonade on the front lawn.
That's a great way to put it.
If I'm a traditional value investor looking at a screen, these numbers look completely broken. How does a multi-billion-dollar entity generate the revenue of a small hobby business?
Well, it looks broken because traditional operational metrics are simply the completely wrong tool for evaluating this specific business.
Okay, why is that?
Because the company has executed a massive strategic pivot over the last few years. Historically, yeah, they were involved in traditional energy-intensive crypto mining operations.
Like the massive warehouses filled with computers?
Exactly. Warehouses consuming massive amounts of electricity to solve complex math problems and earn crypto rewards. But they realized pretty quickly that that is a high-cost, low-margin game.
The overhead is brutal.
It really is. So they transitioned completely away from mining and moved into aggressive Ethereum treasury accumulation.
So they aren't even trying to be a traditional operator anymore?
Not at all. They aren't trying to sell a product or a software service. They are trying to become a vault.
Okay, so if they aren't generating revenue by selling a product, what is their actual end game here? Are they just sitting on a massive digital wallet hoping the price naturally goes up?
Well, they are doing much more than just sitting on it. Right now, they hold 4.42 million Ethereum tokens.
4.42 million.
Which makes them the #1 Ethereum treasury in the entire world.
Wow.
And they are the #2 global crypto treasury overall, right behind a very well-known peer that focuses exclusively on a Bitcoin treasury strategy.
Right. We know who that is.
Their entire business model has fundamentally shifted to acquiring and holding Ethereum as their primary reserve asset. So that apparent contraction in traditional revenue we talked about earlier,
The $6,000?
yes, that isn't a failure of the business. It is a deliberate feature of their new model. They are now meant to be valued on their net asset value, or NAV, per share, rather than traditional price-to-earnings ratios.
Okay, that contextualizes the low operational revenue, but I am looking at another metric that honestly feels like a complete typo.
Let me guess, the profit margins.
Yes. They are reporting a net profit margin of 5,719.1%.
Yeah.
Over 5,700%. That doesn't sound like a real business. That sounds like an accounting trick. How does that actually work in reality?
It sounds totally absurd until you break down the accounting treatment of digital assets. That staggering margin, along with an operating profit margin of over 7,000%, is entirely driven by unrealized gains on their crypto holdings.
Aha, so it's a paper gain.
Exactly.
Yeah.
It has absolutely nothing to do with operational efficiency or selling widgets at a massive markup. It is purely the mark-to-market accounting of their massive treasury.
So as the price of Ethereum goes up, their margins explode.
Right. As Ethereum appreciates in price, the per-share value of the company compounds massively. They don't have to hire 1,000 new sales reps, they don't have to build more factories, or scale their operational overhead to double their value.
It underscores the incredible asymmetric leverage embedded in this specific business model.
Absolutely.
Okay, I understand the leverage part, but where is the competitive moat here? Because if their whole model is just buying Ethereum, what stops a major Wall Street bank or a massive tech company from just stepping in tomorrow and doing the exact same thing?
Two very specific things create their moat: scale and protocol integration.
Let's break those down.
First, they operate on a very public philosophy they call the alchemy of 5%. Their stated goal is to aggressively acquire 5% of the total global Ethereum supply.
That is a wildly ambitious target.
It's massive, and it creates a huge structural barrier to entry. They're essentially the largest fresh money buyer of Ethereum in the world right now, which gives them unparalleled market gravity.
They move the market themselves.
They really do. But the second part is what they actually do with those 4.42 million tokens. They aren't just leaving them idle in a cold storage wallet.
Right, you mentioned protocol integration.
Yes, they have deep protocol-level integration, specifically rolling out something they call the Made in America validator.
Okay, hold on. Before we talk about liquidity advantages, let's unpack validators for a second. If they aren't mining in the traditional sense, like we discussed, what exactly is this Made in America validator actually doing?
That is a crucial distinction to make. Unlike Bitcoin, which still uses traditional energy-intensive mining, Ethereum operates on a proof-of-stake system.
Okay, so how does staking work in plain English?
Think of staking like putting your money into a high-yield certificate of deposit at a regular bank. So in this case, your locked-up deposit is actually helping the Ethereum network process and secure its own transactions.
So by participating directly in the network's validation process with their massive token holdings, they're generating native staking yield.
Exactly. They're basically earning a dividend that is paid out in even more Ethereum.
Okay, so let me make sure I have the mechanics of this compounding loop right. They hold the core asset.
Yes.
The asset generates a native yield through validation. That yield increases their net asset value without them having to spend a single dollar of operational capital.
Yes.
That rising value then attracts more institutional capital to their publicly traded stock, which then allows them to buy even more Ethereum.
Precisely. It creates a self-reinforcing compounding loop. It is incredibly hard for any new competitor to try and replicate that loop at this scale without already having billions of dollars in Ethereum to start with.
It's a massive head start.
Pivoting over to the charts, the price action tells a wild story. When you look at how the market is actually trading this compounding loop day to day, the volatility is absolutely heart-stopping.
Oh, yeah.
Even for the crypto sector, which is known for volatility, the stock hit a staggering 52-week high of $161.
161.
But currently, it trades at just $20.36. We are talking about an 87.4% decline from its peak levels.
Losing 87% of your value is usually a death sentence for a publicly traded company. It generally means the underlying business thesis is entirely broken. How can anyone look at that chart and see a positive technical setup?
Because you have to look at the recovery, not just the drop. From a purely technical perspective, that kind of severe drawdown creates what analysts look for as a massive psychological reset opportunity.
Where did it actually bottom out?
It fell all the way to a 52-week low of just $3.20.
Wow. From 161 to $3.
Exactly. But going from $3.20 back to over $20 is an explosive bounce. It shows that massive institutional support stepped in at those lower levels.
They bought the blood in the streets.
They did. That drop effectively shook out all the weak hands, the retail tourists who bought the hype at $160, and it established a rock-solid base of high-conviction holders who actually understand the long-term Treasury strategy.
So what is triggering these buyers to step back in? Is it just random crypto volatility, or are there actual tangible catalysts driving this momentum back upward?
They're reacting to very specific, repeatable catalysts. And this is where the technicals get really fascinating.
Okay.
Whenever the company announces a new accumulation of Ethereum, the chart reacts violently to the upside. Take March 2, 2026, for example.
What happened then?
The company announced they had purchased 50,928 Ethereum tokens.
Just a casual 50,000 tokens.
Right. And the stock instantly triggered a 9% single-day surge on that news alone.
It almost seems like they're effectively training the market. These accumulation announcements act as reliable technical breakouts.
Exactly.
Since they don't have traditional quarterly earnings that matter, because of that $6,000 revenue, every time they release an update on their treasury, it acts as a de facto earnings report.
That is exactly how Wall Street trades it. The market prices in the new net asset value, and the stock breaks out. And you can clearly see the institutional money riding these breakouts when you look at the volume.
The volume is that high.
The trading volume is massive.
Yeah.
We're looking at 39.2 million shares traded recently, against an average daily volume of 41.64 million shares.
That kind of sustained, heavy volume is not a bunch of retail day traders swapping shares on their phones during their lunch break. Billions of dollars are changing hands there.
Absolutely.
That indicates deep institutional participation. The smart money is clearly accumulating shares in this $20 range. But how much of this technical breakout is isolated to just this specific company versus broader macro momentum in the overall sector?
You really cannot separate the two. They're deeply intertwined. In early March, we saw Bitcoin reclaiming that massive psychological and technical level of $70,000 to $72,000.
Which lifts all boats.
Right. When Bitcoin runs, its market gravity pulls the entire digital asset sector up with it, providing a massive macro tailwind. You even have major institutional voices like Tom Lee over at Fundstrat coming out and officially declaring March a turnaround month for the broader crypto market.
Suggesting the macroeconomic bottom is firmly in.
Exactly.
Moving into market sentiment, how is the street actually perceiving this strategy? Because numbers on a chart and macro tailwinds are one thing, but the narrative driving that institutional flow is what really dictates long-term success.
The quantitative scoring on market sentiment is incredibly strong right now. If you look at the major recent news stories surrounding the company and the sector, 4 out of 5 of them are overwhelmingly bullish.
4 out of 5.
And, frankly, the market is being forced to pay attention because of the sheer performance metrics. Despite being down from its all-time highs, the stock has posted an eye-popping 263.3% one-year rally from those $3.20 lows.
Which makes perfect sense. When a multi-billion-dollar asset moves over 260% in 12 months, no Wall Street portfolio manager can ignore it.
They'd be fired if they did.
Right. Retail and institutional investors alike have no choice but to put it on their radar. But is that optimism just backward looking at the rally we already had? Or are there near-term speculative horizons driving fresh capital into the stock today?
The sentiment is deeply tied to near-term catalysts. Think about the expansion of Ethereum exchange-traded funds, or ETFs.
The traditional finance gateways.
Exactly. Traditional finance managers, like registered investment advisors who handle trillions of dollars in retirement accounts, they often cannot buy crypto directly on an exchange due to strict compliance rules.
They need an ETF wrapper?
Right. If regulatory approval expands institutional access to Ethereum globally via ETFs, this company's position as the #1 treasury makes it a prime proxy target for massive capital inflows.
Especially since they are rapidly closing in on that magical 5% target we discussed earlier. With their current holdings of 4.42 million tokens, they already control approximately 3.7% of the total global Ethereum supply.
They are getting very close.
As they inch closer to that 5% milestone, the narrative around their market dominance is only going to intensify.
Which perfectly explains the underlying mechanics of how they actually afford this strategy. They fund these massive crypto purchases through a strategy of selective equity issuance.
Explain that process.
Basically, they are executing at-the-market offerings, continuously issuing new shares of stock to the public to raise cash, which they then immediately turn around and convert into Ethereum.
Let's pause on that, because selective equity issuance sounds like polite corporate speak for printing new shares and diluting your current stockholders.
It is exactly that.
For that strategy to work without completely collapsing the stock price, it requires immense institutional belief. If the broader market thought this was a bad idea, every time they issued new shares, the stock would just tank due to oversupply.
That is the genius of their current market positioning. Instead of tanking the stock, the high daily trading volume, those 39 to 41 million shares exchanging hands, serves as absolute proof that institutional investors are actively participating and absorbing that new issuance.
They are eating up the new supply.
The institutions want leveraged exposure to this Ethereum accumulation vehicle so badly that they're willing to buy the new shares as fast as the company can print them.
We need to step back and look at the risks. Let's dive into the bear case. Because as exciting as a compounding 5,700% profit margin and endless institutional absorption sounds, this strategy carries severe existential risks that you absolutely must factor into your investment thesis.
We absolutely have to be grounded in stark reality here. Risk number one is crypto volatility and regulation.
The big ones.
Their entire corporate thesis and their multi-billion-dollar valuation depends completely on Ethereum maintaining or appreciating in value.
Obviously.
If we see a 20% correction in the price of Ethereum, which, let's be honest, in the crypto markets can happen over a long holiday weekend, that would instantly wipe $2.8 billion right off their balance sheet.
That is a staggering amount of capital to just vanish overnight. And beyond just the violent price swings, what about the lingering threat of regulatory crackdowns? We have seen the government take aggressive actions against the crypto space before.
Regulation is a massive looming headwind. Staking, in particular, operates in a very murky regulatory gray area.
Because it looks like a dividend.
Exactly. If global regulators decide to take a harsh stance on decentralized finance, or specifically classify staking mechanisms as unregistered securities offerings, it could severely impair their entire yield strategy.
They'd be paralyzed.
They could be holding millions of tokens that they're suddenly legally barred from generating yield on with their Made in America validator.
That is a very real threat. However, you have to contrast that risk with the built-in mitigation factor we discussed at the very beginning of the show.
The discount.
Right. The stock is currently trading at a massive 66% discount to its net asset value. That $4.7 billion gap acts as a built-in margin of safety.
It acts as a buffer.
The market is already pricing in a significant amount of regulatory and volatility risk. Even if Ethereum took a 20% haircut tomorrow, the value of the assets would still vastly exceed the current market capitalization of the equity.
That is true, but it leads us directly to risk number two, equity dilution. We just discussed their strategy of selective equity issuance to fund their token purchases.
Minting the shares.
Well, the dark side of that strategy rears its head during a crypto winter. If the company is forced to issue shares during a severe crypto downturn, when their stock price is deeply depressed, existing shareholders get massively diluted without seeing any corresponding upside in the value of the Ethereum the company is buying.
It is the ultimate double-edged sword. It can become a complete death spiral if the timing is wrong. They print shares at the bottom to buy an asset that just continues to fall.
Exactly. But again, there is a historical mitigation here. If you look at their track record, particularly over that massive 263.3% one-year rally, their Ethereum accumulation has vastly outpaced the share dilution.
They've proven they can walk the tightrope.
They have proven that, so far, they can manage the share issuance in a way that creates net positive value for the shareholders. As long as the appreciating crypto asset outpaces the share printing, the thesis holds. But make no mistake, it requires absolutely flawless execution from their management team.
And finally, we have to look at risk number 3, geopolitical headwinds. It is vital to note that in early March, we saw a noticeable market pullback driven directly by tensions in the Middle East. Looking at this purely through an analytical market lens, how does international geopolitics impact a digital asset treasury company?
Analysts describe these types of geopolitical events as introducing a risk premium into the broader financial market.
A fear gauge.
Essentially, yes.
Mm.
When global tensions rise, capital tends to flee from risk-on assets like crypto and speculative equities. Investors retreat to traditional safe havens like gold or government bonds. It creates immediate and sometimes violent downward pressure on volatile stocks like this one.
But the consensus among market analysts, including voices like Tom Lee, is that these specific pullbacks are currently viewed as transitory headwinds.
Correct.
They create short-term price volatility, but they don't fundamentally alter the long-term mechanics of Ethereum supply and demand or the company's accumulation strategy.
Bringing it all together, what is the final verdict? We have thoroughly analyzed the massive discount to NAV, the wild technicals, the bullish institutional sentiment, and the very real risks of extreme volatility and share dilution. How does this actually score out for an investor?
Based on the comprehensive data across all those vectors, the final bullish score comes in at an 8.2 out of 10.
A very strong score.
To summarize the elevator pitch for the multi-year investment thesis,
Yeah.
you are looking at a company that has successfully positioned itself as the premier institutional vehicle for Ethereum accumulation. They are holding $14 billion in highly liquid crypto assets, yet they're trading at a massive 66% discount to that value.
The numbers speak for themselves?
They have proven repeatable catalysts with their accumulation announcements, and they're riding very strong macro tailwinds with Bitcoin pushing past $70,000.
So how do you actually trade this setup? The actionable horizon here is a 6 to 12-month hold. This isn't a quick day trade. And given the extreme volatility, you have to remember that massive 52-week range of $3.23 to over $161 position sizing is critical.
Keep it manageable.
The suggested structure is a 2% to 3% portfolio allocation. You are targeting a price of $35 to $45 over that time frame, assuming the underlying price of Ethereum appreciates another 20% to 30%.
But you absolutely must protect your downside. You need a strict stop loss set at $15. That gives the trade enough room to breathe through normal day-to-day crypto volatility, but it decisively cuts your exposure if the macro thesis breaks down or if sudden regulatory actions severely impact their staking models.
Prudent risk management is non-negotiable here.
Before we wrap up, I want to leave you with a broader, almost philosophical question to ponder. We talked extensively about their alchemy of 5%, their mission to acquire 5% of the total Ethereum supply.
Right.
If a single publicly traded institutional entity successfully corners 5% of a major decentralized protocol's total supply, what does that actually mean for the future of decentralized finance?
It is a fascinating paradox. The entire foundational ethos of crypto was built on decentralization, specifically distributing power away from traditional financial institutions.
Away from Wall Street.
That's exactly. But if Wall Street vehicles accumulate enough of the supply to effectively control major staking nodes and heavily influence protocol governance, does the ultimate decentralized asset inadvertently become centralized through the back door of public markets?
It really makes you wonder who actually owns the future of the network, and it is a question that will undoubtedly define the next decade of digital assets. Thank you for joining us for this analysis. As always, remember to subscribe, like, and comment to this video to support the Investing Talk podcast. We will see you next time.